Hey everyone, how's it going? I'm Ishan Savaram, an ISM 1 student and senior at Independence High School this year. And as part of my ISM original works, I've compiled a course to teach traders how they can start implementing a strategy and various ideologies to help them trade more objectively. This is going to be a step-by-step guide that will allow individuals to end this video with a completely new trading strategy that they can go ahead and implement right away to make quite phenomenal returns. But more importantly than that, individuals will learn how to actually create strategies that are objective so that they can trade objectively and so the skill set can be applied to create as many different strategies as one wishes. So with that being said, let's get straight into it. We're first going to be going over systematic trading versus discretionary trading. Then we're going to be talking about how to start, what types of tools you may need. Then we'll be going over the framework for actually trading objectively. Then we'll be doing a walkthrough of a real trading system. This was the strategy that I was talking about. Then we'll apply it to the real world and then wrap it all up at the end. Before we begin, this course is optimized for every retail trader, including beginners. I've made this in a method in which, as long as you are able to conduct a tad bit research outside of this course, you should be able to do most of the technical side, even if you're a complete beginner. With lots of LLMs, AI software, and coding assistance, it's possible to do all of this with barely any experience. That being said, if you do have experience in things like Python and Excel, it can be very helpful. With that being said, let's first get into the difference between systematic traders and discretionary traders. Discretionary traders typically rely on subjective signals for their trading criteria. For example, if a discretionary trader saw that a news release, for example the CPI, was bullish, they buy it. Now, even though the news release was bullish, the following price movement might not have any predictive power on what the news has said. The news can't really predict price movement, but a discretionary trader believes that it does without testing it objectively. That being said, I'm not one to say that it doesn't work. If it works, it works. If it doesn't, it doesn't. But the idea is that if we can test something and make sure that it works, that's a very good way to avoid capital loss and very good way to prove that something actually works before you put your own money into it. Now, a systematic trader on the other side, these individuals typically execute their orders on a predefined criteria on a real trading edge proven through data analysis. So imagine we're talking about the same thing as before. If news comes out bullish, we go long or we buy the stock. Now, we could test this and we could create a strategy that happens every time, hands-free without us touching it. That's what a systematic trader does. They create these types of algorithms, automated systems to actually trade automatically to get the best entries, the best timing, and everything that is optimized for what the data in the past has set. Instead of knowing, instead of assuming that a mechanism has predictive power, they know that it has predictive power. And in fact, they know how much of an edge they have. Another example is that if you go long every time a leading asset goes up by exactly 2.5%, it might have consistently shown predictive power on the underlying. Now, this is a quite technical example, But assume that if something goes up 2.5%, then another stock that's pretty correlated to the leading asset might also go up. It's something that you can test and see if it works. If this works, we can trade off of it. If it doesn't, at least we're not risking our own capital on it. Sometimes negative results are just as beneficial as positive results for that case. So let's get straight into how to actually start. The tools that are required are Excel, and if you go to a university or if you have the Microsoft 365 license, then Excel should be within that or within the features of either your university or the license. Furthermore, we're going to be utilizing Jupyter notebooks. And one thing you can do right away is download Anaconda Python. If you just do a quick Google search and search up Anaconda Python download, go ahead and download it. It's a green logo. And in fact, it's this right here. If you see something like this, go ahead and download it if you're looking to continue. Because this is where you can test things out much easier. And of course, your preferred LLM. And this could be ChatGPT, Gemini, whatever else. For this video, I'll be using ChatGPT simply because everyone knows about ChatGPT now. Now, this is not needed, but it's definitely helpful because if you understand these, you're likely gonna have a head start on the other people that are taking this course simply because they can reason and create edge ideas or strategy ideas within an edge much easier simply because they have that head start on financial markets experience and technical experience. So basic understanding is helpful, same with technical experience. But once again, it's not needed. So with that being said, I'm very excited to show you guys how you can create a real system. But before we do so, let me go over the framework that we use to create these strategies. The framework is first, we find an edge idea. Now, there's a variety of different ways to find this, and we'll go more in depth in this later. Second, we're gonna reason why it works. For example, if you just see that this random stock goes up 10% every time Bitcoin goes down 2%, and it happened maybe 5 to 10 times, we know that it happens, but why exactly does it happen? Us as systematic traders, we're not quantitative hedge funds. We're not these professional big money traders and institutions. We're just random retail traders sitting at home wanting to make a little bit extra cash in the long term, right? Now, we want to reason why it may work because we want robustness. And what I mean by this is we don't want something that's there only for a few months or a year or so. We want something to stay consistent over the long term so that we don't have to keep dilly-dallying with it and we have confidence that it's a good investment. We'll then go over how to gather data, then how to organize data, then statistical testing because that shows you that a relationship is actually there, and we can do this through various means. But for the sake of this video, we're going to be only doing a scatter plot and bar charts. Pretty simple stuff. A lot of you guys may have taken a statistics course in your lifetime. That should be pretty sufficient. If you have any questions regarding whatever I'm doing, please feel free to go online and search up any of the terms which I'm saying. I've created this course so that you guys can benefit off of it, so please feel free to take advantage of this and do your own research as well because practice will make you get the most out of this course as you can create much more strategies. After we test statistically, we're going to also backtest the strategy. We're going to see if it works in the real world. And then finally, will be updating and managing our portfolios. Like a high-class former hedge fund trader said to me, diversification is the only free lunch in finance. So it's very important to stack your different strategies and keep track of which edges work and which edges are plateauing. We'll get more into that later, but now I'm very excited to get into the real sauce. Right now, we're going to be creating a complete trading system. It's a pretty simple system, but that was my aim. I want to create a system that many individuals can start implementing at home. Now, you'll learn what alpha decay is later on in this video, but this strategy is pretty robust simply because of the assets that are trading within. So, let's get straight into it. This strategy is essentially found on SSRN, a great place to get market edges alongside Wiley. You can just search these up on your Chrome browser and you'll find it, right? And essentially, what we find through the research paper is that end of month institutional rebalancing between stocks and bonds. What this means is that fund managers are required to have a 60-40 split. What this means is that fund managers, before they have to report to their bosses, they want 60% stocks, 40% bonds. So, right before they have to rebalance, we have to think about what happens to these stocks. Now, I'm actually going to find this online. Like, we understand, and I'm telling you guys where I found this paper and the edge idea and everything. But no, I can promise you, nobody really wants to read a full research paper fully, especially if it's heavily long. If it's like 10 to 30 pages, that's pretty reasonable. You can read through it. But anything more than that is gonna be a burden to read through, even if it provides extra value. And once again, our handy dandy helper, our LLMs can do a lot of great help with that. So I'm gonna go ahead and simply pull up the SSRN paper and show you a quick trick that you can do with it. Alright, on my other monitor, I just pulled up the research paper, the unintended consequences of rebalancing. We see that it's pretty credible. We have Ohio State University, Duke University, a company. It seems pretty it seems pretty good. And additionally, it's pretty new as well. It's in 2025. So, well, all we have to do is download the paper. You have it downloaded and simply plug it and drop it into ChatGPT. And then you can make a really dumb and simple prompt. Our job is not to overcomplicate things to an extent. We want to dumb down as much as we can so that we can comprehend it, right? So let's just go ahead and tell ChatGPT what to do. Hey, okay, let's just say, imagine you are a professional quantitative trader at the world's top hedge fund. You created this paper. Really, but just for the prompt. I want you to give me a really dumb summary of what is happening, what they did, etc. And what it's going to do is it's going to read through this entire paper and look what it says. The paper in one sentence. Big institutions keep rebalancing their portfolios in a very predictable way, and that predictability moves markets, costs everyone money, and lets smart traders front run them. What problem are they talking about? Huge investors. Now look at this. Stocks went up a lot. Now we have too much stock. Sell some stock. Bonds went down. Now we have too little bond. Buy bonds. This is honestly a perfect explanation, right? We'll get into this later when we're back into our slideshow, but essentially, if these hedge funds are to hold this 60-40 split between stocks and bonds, right? What happens if stocks go up more than bonds, right? Then their entire portfolio might look like 6, 7, and 33. Is this a 60-40 split which they're required to hold? It's not. So what do they have to do? They have to sell stock and they have to buy bonds. Does it make sense, right? Because if stocks outperform, they need to sell some stocks. If bonds outperform, they need to sell some bonds. But if bonds underperform, they have to buy bonds to simply hold that 60-40 split. So now, if this 60-40 split is a case, when does this occur, right? Well, every month, every quarter end, when waits just too far, on calendar schedule. This is all given in the paper, and ChatGPT perfectly summarized it for us. Why is it a big deal? Well, you can read this. And look at this. Mm, mm, mm. Now, yeah, as you can see, the authors build a strategy from this and they get a Sharp that's greater than 1, and that's really phenomenal. And look, the trading edge exists only because institutions are clumsy. It's not because of a quantitative edge to an extent. It's rather more of a robust type of edge, right? It's exploiting mandates and committees and rules that hedge funds have. Unless the hedge funds change those rules, which sometimes have to be published, they have to we'll know and we can stop trading it. So essentially the point from this is that ChatGPT can perfectly summarize this for you, right? It can literally do all the hard work for you. It simplified it very perfectly, all from some dumb prompt which I wrote. And that's what I'm trying to say. You don't have to overcomplicate things. It's very easy to overcomplicate things, but really dumb it down and understand what happens. So let's continue. Okay. So let's reason the strategy, right? Like we've mentioned before with the example. If stocks outperform bonds in the first 15 trading days, right? Because think about it. If hedge funds have to rebalance, right? And they have to rebalance by the end of the month or by the start of the next month, when when do you think they would rebalance? Just human nature question. If someone is given an assignment that is due on the end of the month, when do you think they will submit the assignment? Will they submit the assignment on the first week of the month, the second week of the month, the third week of the month, or the fourth week of the month? I could bet that majority of the time they're gonna do it on the fourth week of the month, and that's just simply human nature, right? They typically do things right before the deadline, and that's completely fine. But essentially, we're saying that if stocks outperform bonds in the first 15 trading days, right, which is the first 3 weeks of the month, we predict them to underperform bonds in the last 5 trading days. Why? Well, think about it. If stocks do very good in the first 3 weeks and bonds don't do as good, our split will be will be like 60. No, okay. At the start of the month, we have a 60-40 split, right? Now, let's just say 3 weeks. First 15 trading days, stocks outperform bonds. So this goes up more than this. So what happens to the split? We might have something like we mentioned before, 63 and 37. So we're a hedge fund and we're mandated to have the 60-40 split. So what do we have to do? Well, we have to sell some stocks and we got to buy some bonds. And if that's the case, what do we expect about the relative performance? Which is going to outperform the other? We're expecting bonds to outperform stocks. We predict the stocks to underperform the bonds in the last week. And because these bonds outperform in the last 5 days, right? Say in the last week, bonds are pushing up and they're outperforming stocks. We expect them to underperform in the first 5 days of the next month. Why do we expect this? Well, let's go back to this example, right? 3 weeks, they have a 63-37. Now in the last week, so fourth week, they have to rebalance back to a 60-40. So they buy this and they sell this. No, apologies. They sell this and they buy this. Now, now that they're done selling this and buying this, what happens when this pressure is gone in the first week of the next month? What would you expect to happen? Well, there's no more institutions that are buying this anymore. And because the institutions are not buying this, they might sell it, perhaps, or they may buy stocks, perhaps. But the main thing is that because this pressure is gone, we expect bonds to underperform in the first 5 days simply because they aren't required. These institutions are not required to buy bonds. Bonds look good. People might buy them to look good. But the thing is, it's because they're mandated to. So I hope that was I understand that may be a bit confusing if you're a bit new to the markets. I tried to dumb it down as much as I can. Hopefully you understood it. If you did not, please feel free to use the resources in the original works to please feel free to use the resources in the original works to go ahead and put this into ChatGPT and simply ask it to explain things to you as much as you can. Essentially, because these institutions have rules, when something happens, they have to balance it back down to their mandate, right? Because their mandate is here, but their mandate went up here, so they have to balance it. Now that their mandate is not there anymore, what do we expect to happen? We expect the mandate to go back up. That's why this entire phenomenon occurs. So, again, you can feel free to use any external resources to get a bit more understanding towards it, but this example that I've listed here, it's basically the main thing, and it could be applied vice versa as well. So, with that being said, let's talk about how to gather data. But first, we got to reason what data do we actually need? Well, what things are we talking about? What things do we think have a relationship to another? I mean, we're saying that if the first 3 weeks something outperforms the other, then in the last week, this thing should outperform this, simply to balance things out, right? So if that's the case, we need the first 15 days, right? Why? Because that's the first 3 weeks. And then we need the last 5. Why? Because that's the fourth week. A quick tip is to include or understand that a trading week is 5 days because there's only 5 trading days in a trading week. So essentially we know two of the pieces of the puzzle that we already need. First 15 days, last 5 days. But we also said that when the rebalancing pressure is relieved, we expect the other thing to outperform this thing. So what do we need? And we expect that to happen in the first week of the next month. So first 5, right? So with that being said, this is the data that we need. We need the first 15-day performance, or essentially to make it easy, we need the first 15-day performance, we need the first 5-day performance, and we need the last 5-day performance. And since we're talking about stocks and bonds, what are the most overarching things of both of those? Well, SPY is the main one, right? S&P 500, it's stocks. Well, let me move this to a white color so it's easier to see. You got SPY and bonds. What is bonds? The main thing is really TLT. You can test this on other thing, but for the purpose of our course, use TLT. So SPY and TLT, we need these 3 different data types, right? We want the returns for the first 15 days, last 5 days, first 5 days. Now, this might get a bit confusing here, and I'll walk you through step by step how to get this data. But essentially, we're going to use ChatGPT to give us a tutorial, but the daily data is provided by Yahoo Finance, and if you can use Y Finance, you can make it very easy, and you can use ChatGPT to use Python. So, let's do it. We have this here, right? With a research paper already plugged in. So simply ask ChatGPT, I need some help in gathering data. Okay, essentially there's this thing called open, high, low, close. That's the data that Yahoo Finance gives. If you take a look, when we search up Yahoo Finance SPY data and we open it up, go to historical data. It gives you open, high, low, close, adjusted close, and the volume. Essentially, what we're just going to need to find the returns are simply the open and the close. Why? Well, I recommend you guys search up what a candlestick is and learn about what open, high, low, close means. Essentially, the open is where market opens on any given day. So in this case, December 12th, 2025. So today. Price opened at this price right here. Where did price close? Price closed down at 679. So today we went down. No, sorry. Price closed at 681. So today we went down by around $6 to $7. But it shows you the entire day's return, and that's really what we're looking for. Now previously you were able to export this Yahoo Finance data, but now they're requiring you to have Pro, right? It's making you pay for all this, and we don't want to pay for any of that, right? Unless we need to. If you want to pay for it, you can go ahead and download it, but Y Finance is a method to get this. So if you have not already downloaded Jupyter, go to Anaconda and open up a Jupyter Lab notebook, or simply a Jupyter notebook. It should look somewhat like how I'm doing it here, and you can watch a quick tutorial on how to use it, but it's pretty straightforward, right? I'll show you. I want to gather data using Yahoo Finance on a Jupyter notebook. Hopefully this makes sense, right? We want to gather data, we want to use Yahoo Finance, and we're going to do this using our Jupyter notebook. I need you to make the code so that I can export the entire data to a CSV file. I want the open, high, low, close, right? OHLC, open, high, low, close. Data. Please remember to import all the necessary libraries, etc. You can simply copy my prompts. Don't worry about my spelling. It doesn't matter. But please remember to import all the necessary libraries. And simply, when we do this, we can get it. And there's another thing called pandas as well, but you'll get to know that when you get sooner down the line. ChatGPT should do most of this for you. I want to get daily open OH open high low close data for both SPY and TLT for the for as long as I can. Full historical data. Give me the code to put into Jupyter Notebook. Perfect, right? So first, we'll just go ahead and do this, right? So we go ahead and copy this. I'm pretty sure you can copy the entire thing, but you may just want to do it step by step, like such. But you can go ahead and simply, and you may want to rename this as well. Oops. Rename this. We'll call this SPYTLT v2. Go ahead and import this. And all you gotta do is click this button called run, or click shift and enter together. No module. Okay, aha. So before you import it, you want to do install what? Okay. If this error comes, simply, I know how to do this, but simply copy it. Say okay, hold on. I think this works, but this error occurred. You need to first install Refinement. Copy and paste the error and do this. So essentially, do this. Copy that. You can go ahead and delete that, but simply pip install Refinement, enter it, and as you can see, it's downloading it. And this might take a while to run, but it should be all good. And you can see how long it takes here. So it's not executed yet, as you can see. Do we got to install pandas or anything else? And we're simply just gonna install it just because. See, now it's added Refinance. Now we're installing pandas, and as you can see, it's already satisfied. So now we simply should be able to simply copy this code and get it. And if you open this file here, you can get the different things, but enter. And it's running right now. I'm gonna pause this video and come back. Oh, perfect right there. SPY TLT daily open high low close full data.csv. And as you can see, it pops up here. If you don't see it, just make sure to click this file button on the top left. Come here. Simply all you got to do now is right click it and click download. And now you have a CSV. Now, with this CSV, all you got to do is go to Excel. And I'm simply using the web version because it's simple. But click upload file, click on the file, and import it in. And it shall load. And there we go. Now this put everything there, but let's see when the TLT comes. So look what it did, right? And sometimes these error occurs. That's completely perfect. We see that they're going up and down together, right? So we'll do this. We want two separate CSVs. I want two separate CSVs. One for SPY and one for TLT. And it already asked us that before, so we're simply working with what it said, as you can see here. Alright, right there. Simply do this and just run the code once again. SPY daily. Where's the file? I'm just checking. Open hello close data, create a folder for us. Now all we gotta do is download it. Download it and simply do the same thing. So you go back and upload the files. Now I'm gonna just duplicate this tab real quick. So we got SPY daily, and then we got TLT daily. So the step that we did right now, we simply gathered the data. So I mean, now we do have the data. And we can, realistically, we can do the rest in Excel, right? Because 1st through 15th, but that can be a bit difficult, right? First 15 trading days of a month. So let's just ask ChatGPT once again, because we want the 3 different data types, right? Would it be easier to separate the data into 3 groups in Excel or Jupyter? We want returns per month for the first we want returns per month. Okay, hold on. We just gotta take this, put it here. We want returns per month for the first 15 days of a month. Days of a month. First 5 days of a month. And we gotta indicate that they're all trading days. Doesn't have to end at the 5th, etc. i- if if you can provide either the code or Excel formula to do this, code would be preferred. We have it here, and it's going to be quite difficult to organize. Like we are going to go ahead and do, you want to organize the data. They gave us open, high, low, close, but we need the relative performance. We want stocks minus bonds. Why? We want to compare performance, or we want to see if one outperforms the other, will the other outperform this one? So if this is stocks on the left and bonds on the right, what is the relative performance? This is going to be positive. What is the performance here? It's going to be negative. So that's what we want to see. If our situation is true, sometimes they're going to be positive correlation, sometimes it'll be negative. So, I mean, it gave us the code to do the returns. Now we're simply going to ask it once again. Now, instead of just the returns being separate, I want the returns of the relative performance between both. So essentially, first 5-day returns, relative return of stock of SPY and TLT, stocks minus bonds. First 15-day relative return SPY TLT, again, stocks minus bonds. And finally, last 5-day relative return SPY and TLT, stocks minus bonds. You don't have to be this repetitive. It probably gets it after one or two, but this should do the job. SPY minus TLT for the return set. And I want 3, and I want the output CSV to have 3 columns. One with the first 5-day relative return, second with the first 15, third with the last 5. They should be aligned by month. And also, and if there is no data for both SPY and TLT for a given month, ignore that month. For early months where there is data for one asset but not another. Essentially, you can go ahead and copy what I've written here. I'm doing this completely step by step with you guys. Essentially, you can copy exactly what I've written here. Enter. Now, this is the beauty of Python, right? We can go ahead and do this magic with Excel where we insert formulas and do a variety of different things. But Excel is much more useful in plotting outer data in terms of scatter plots and all that. While Python, you can help crunch the data much easier. Like, take a look at how easy this is. We don't have to write any of the code, and I mean, ChatGPT just gives it to us quite easily, right? Let's go back home here, and it saved it home to SPY minus TLT relative returns. Let's go ahead and download this. Go back home, upload the file, and import it. And let's see how it did. And I mean, would you take a look at that? And I'm gonna make sure and ensure that the data is aligned, right? And I'm simply gonna search up TLT Yahoo Finance. Go here, go to historical data, go to max. And you see that 2002, January 13, 1993. No, we just want it from 2002. And when is it? It seems to have aligned nicely. So, I mean, this looks right to me. Sometimes it doesn't look greatest at first glance, but usually it does it right. If it doesn't do it right, you can keep tampering with it to debug. And honestly, debugging is the hardest part, but it looks to have done it right. Now remember, the first 5 days of the month, we're gonna move the column to the side, right? Aha, we can't edit this yet. Convert. Okay, there we go. We're simply gonna move this here. Now, we want to see if the performance of the next month affects this month. So we don't necessarily need it to be aligned, right? So I'm going to go ahead and simply shift this one, insert, shift cells down. Okay, hold on. Insert, shift cells down. Now this should do the job, but we can go ahead, go all the way down and make sure. As you can see, it did it pretty nicely. So this is essentially all that we need. Hold on, I'm trying to think. Ah, we did wrong. Insert shift cells. Okay, I'm gonna just go ahead and create another column. I'm gonna copy this data and I'm gonna paste it up here, like such. Yeah, perfect. I'm gonna move this here. Why did I do that? Well, essentially we moved the next month and aligned it with this so that we can simply line these up by column and work in that sense. So what are the three scatter plots that we want to do? We've gotten the data, right? We've did the data step-by-step process. I've done it in front of you guys using the code in Jupyter. As you can see, gather the data separately, filter to get the three different sectors that we want, and now we're going to do the statistical testing. We want to visualize the relationship between the first 15 days and the last 5 days. And we can set up these hypotheses, right? We've already talked through this, but essentially, for the first 15 days versus the last 5 days, if something outperforms, we want it to underperform it. If something outperforms in the first 3 weeks, we want it to underperform the other asset in the last 5 days. And because there's this opposite effect, like we've spoken about, right? And I can go ahead and draw it once again. But if this outperforms that, then we want that if stocks outperform bonds, we want bonds to outperform stocks in the last 3. And this essentially opposite, right? Because this is positive, this is negative. Stocks minus bonds, stocks minus bonds. This is bigger than that, so it's going to be negative. This is bigger than that, so it's going to be positive. So at the first 15 days, if it's positive, and in the second it's negative, what type of correlation is there going to be? It's going to be negative, right? If two things don't, if they're correlated, we're going to have a positive slope in our scatter plots. If they are not correlated, or pardon me, if they are positively correlated, they'll have a positive slope. If they're negatively correlated, or if they have opposite things, right? If one is plus, one is negative, there will be a negative slope. If both are plus, it will be a positive slope. If both are negative, it will be a positive slope. That's what I mean. That's what we want to see for the first 15 days versus the last 5 days. Now, we also said that we want the last 5 days. Say we are doing this because of rebalancing pressure, then in the first 5, it's because that rebalancing pressure has relieved, you want to see a negative correlation as well. Because here it's negative, here it's positive. So you want a negative correlation there as well. That being said, we want a positive relationship between the first 15 days, right? Because if this was like this, that caused this to happen, and now that it's relieved, we come back to this, we ultimately see that it's going to be a positive correlation. Now, this kind of confusing. 2 scatter plots could do the job greatly, but 3 scatter plots can help confirm that, and they all make sense. That's the main thing. If you're having trouble understanding, again, you can rewatch the video as many times as you need, but this is essentially the way to do this. We're just comparing the relationships between our hypotheses to see if there's something to actually leverage. We talked about this occurring, right? We talked about if this happens, then this happens. If stocks outperform bonds in the first 3 weeks, we expect stocks to underperform bonds in the last 5 days or in the last week. And if stocks underperform in the last 5 weeks, if stocks underperform in the last week, we expect it to outperform in the first week of the next month. Why? Because of that rebalancing pressure. Again, you can take what I've said, ask ChatGPT what I'm saying as well. It can help a lot in understanding. But now that we have the data, I'll show you how to do a scatter plot. So we said first 15 and last 5. I just held shift, right? I'm holding shift right now. I hit the right arrow. Now I clicked control, and then now I click the down arrow. What that does is that grabs all the data. Now click insert, and then we see this right here, scatter with only markers. Click that, and we see that this is what we get here. Now we want to click format, right click and click format. Remove the title, we don't necessarily need it, or the legend, simply for simplicity purposes. And what we want to go ahead and do is go to series 1, click on trend line 1, click on equation and values, and do this, and make the outline red so it's easily visible. Make the weight much heavier, say perhaps 3, and make it a straight line, like such. And we can move this r squared up here. And what is r squared? R squared is simply showing us if our results are significant or not, right? So we've said that we want a negative correlation. Well, if you take a look at it, is it negative or positive? Well, it's quite clearly negative. Negative slope in the equation as well. And r squared, it's again telling you if these results are meaningful or not. It's telling us that 10% of this is explained by our equation there. And in finance, even a 0.01 r squared can potentially result in profits. So as long as it isn't like completely zero, like this, and it's a bit high, especially if we're doing a long-term strategy in which we're using daily chart, we want it to be anywhere from 0.05 plus. Simply just a rule set in hand, but of course it can differ, and that's why backtesting is important. But essentially, what do we see? We see that the negative correlation actually occurs. Okay, hold on. I'm just going to go ahead and refresh the page. I'm going to take this, I'm going to copy it, and I'm going to paste it up here, simply so we have it. Now, we did the first 15 and the last 5. Now we want to see if the last 5 can predict the next first 5. So same thing, I'm holding shift, hit right arrow once, click control, hit the down arrow. Now this isn't really going to help us, so I'm just going to go ahead and, cancel. I'm just going to grab everything like this instead, since we don't have too many columns. Simply because it's not aligned at the bottom. But there's that. insert again, scatter plot. Now this one, as you can see, it looks a lot more random. But format it once again. Remove that. Go to the vertical, not the vertical axis. Go to the series. Trend line. Outline red. Weight 3 dashes straight. Equation and values. Display r squared. I mean, as you can see here, the r squared isn't the greatest, but we do see that some sort of relationship is there. So things are starting to even out a bit more, but I mean, we wanted to see that correlation, right? This isn't completely zero, it's 0.004, but we just wanted to see if that negative correlation was there. Now, we do see that that negative correlation is there. That's a good like idea that we're seeing. Now, with that being said, r squared is a bit low. So that's just something to keep in mind, and that's why backtest is important. Even though the r squared is low, we want to see what a backtest can yield. So I mean, now that we have that, we want to do one last scatter plot. We want to see if the first 15 and the next first 5 are correlated. So I'm gonna click Shift Control down arrow just to grab this data, and I'm gonna shift and go up one arrow just to grab that. Then I'm gonna scroll all the way back up. I'm holding no, actually, wait. I'm holding shift again. Okay, hold on. Okay, there we go. Now I'm holding control and I click that. Now control shift down. There we go. Now we have both of them highlighted. Insert, scatter plot, and this one you'll go ahead and see what we're talking about as well. I'm gonna just copy this, scroll up and paste up here. And let's format it once again. Remove the chart title and the legend. Go to series 1. Essentially doing the same thing once again. Outline red, straight, weight 3, equation and values, display r squared. I mean, take a look at this now, 0.04434. So what we see is that it's definitely, like, finance we said it's 0.05 is a good one. But I mean, anything from 0.01 can technically work. It's typically what I like to see. Backtest will do a lot for us though. But essentially, we see that exactly what we said is happening. If something outperforms in the first half of the month, we want a negative correlation with the last half. That's a check. If something in the last 5 days when rebalancing pressure is happening, and the next 5 days when rebalancing pressure is gone, we want that to have a negative correlation. Check. We want the first 15 days of the last month and the first 15 days of the next month to have the same correlation, simply because of that diagram and drawing I've showed earlier. So check. So what have we done now? We've essentially just verified that an edge is there. We've verified that the relationship that we're talking about that we want to leverage, this rebalancing ideology, where this happens, where this relationship occurs, these scatter plots essentially prove that. And there's a lot of noise within it, but we proved it. Now, scatter plots are a very simple way in proving things. There's a lot deeper you can go with statistical testing, but this is a great way to get started. Now, going back to the slideshow, this was a scatter plot I've taken earlier this year, and you can see how the numbers are starting to differ, right? We're seeing that the relationship, the edge that we had from the scatter plot is starting to decrease a tad bit, right? Because at 0.04, 0.004 used to be a 0.009. So you can see how it decreased. But essentially, we do see that the same ideas are showcased in these scatter plots as well. And I've essentially just reconstructed those scatter plots with more recent data in this Excel sheet. And I've worked with you step by step through all the code, which literally ChatGPT created for us. And yeah. So with that being said, we've proven that the edge exists, and it aligns with our hypothesis. Now, we want to backtest it, right? We want to check, we want to see what we can do to leverage off this inefficiency. We want to make money off of it. So let's test what would happen if we make money off of it. So, what do we want to do? What do we want to do with the strategy? If, well, think about it. We simply just want to do what the scatter plots are showing us. So in the first 15 days, if stocks are up, bonds are down. And to explain this a bit further, I'm gonna pull up this diagram. Okay, I've just imported these diagrams and assume that all of them are green. Or in fact, give me a second. Okay, there we go. Simply, I'm not gonna explain this once again. I feel like I'm over explaining things a little bit, but essentially you can go ahead and read through this diagram and simply follow through the rules. And this is a good exercise for you guys as well. Think about why we're doing what we're doing and why it makes sense. We simply want to follow what's happening in the scatter plots, right? So I'll explain a little bit. So say our relative performance is positive, this is negative. If it's positive, right? If this is like, if the performance is like this, in the last 5 days, if we know that rebalancing pressures are going to make it like this, what do we want to do? Well, of course, we want to sell this and buy this so that it can look more like this. Essentially, we're doing exactly what the institutions are doing. And we're doing that for all four relationships as well. So with these rules in set, we have to move and use our data to actually run a backtest. Okay, backtesting is where it starts to get a tad bit confusing. I have the master Excel sheet with all the different data types and everything within this, and all the old scatter plots are within this as well. This is linked in my original works. This will be linked in the description as well within the Google Drive folder. Feel free to check that out. But essentially, there's various different ways to backtest, but I'm gonna show you a pretty easy way. Again, we're coming to our good friend. We have a trading strategy idea using this phenomenon. We want to simply follow the idea that if the relative performance is positive in first 15 trading days, I'm gonna upload a picture of this because I do not want to keep writing too much. So there. We have a trading strategy using this phenomenon, and now we want to run a back test. I have attached the strategy rules. I want to do this back test within Excel. I have these three columns. 1. First 15 days returns. 2. last 5 days returns 3. Next first 5 days returns aligned, shifted up for testing scatter plot. So, for example, the first column's January is aligned with this column's February. Okay, date. Sometimes prompting can be the hardest part as well. You simply give this as prompt. Now give us a way to backtest using the strategy rules within Excel. It should be pretty simple. So what I'm going to go ahead and do right away is I'm going to duplicate this tab right here. And we have this. We're going to go ahead and delete these scatter plots. Or at least attempt to delete these scatter plots. Cut. Cut. Then we can leave that there, but essentially these are the columns that we need. We can again move this all the way down there. We don't need that. We just need a little bit of room here and these 4 columns. Let's see. First 15, nice. That's fine. Already shifted as you said. Okay, perfect. In E2. So right now we're simply aligning by the regime. I understand how to do this simply because of experience. It's simply telling us is the performance positive or negative, right? So let's go ahead and copy this and paste this in E2. And what we have to do now is simply drag this all the way down. And I'm simply going to go ahead and remove this data simply because it's not useful for us. And we can call this greater or negative. Just simplify it a lot. E2, P&L from last 5 days trade. And again, we're going to shift it all the way down. Like such. And then we're going to put this in G2. And then once again, scroll all the way down. Simply follow exactly what ChatGPT is saying. And try to understand what it's saying as well. First, we're using it to see if we're in a bullish regime or a bearish regime. And all we're doing is simply longing and shorting. We're simply doing what the scatter plots are saying. And we're doing this through simple addition, subtraction, multiplication. And we're longing and shorting it in that same manner. Did we do F2? We did G2 too as well. Perfect. And now total monthly strategy return. Now we're adding the strategy between the last thing and the first thing, right? When we long it, hold on, let me just slide this over here. For this thing in the last 5 days and the first 5 days as well. Hold on. Last 5 days trade. First 5 days trade. Right, because last 5 days, first 5 days. Perfect. So go ahead and do that. Copy, paste it. And once again, scroll all the way down. I'm going to go ahead and cut these as well. Equity curve. right, not 2, plug this in, I3 and down, plug this right there. So right now all it's doing is adding the performances as we go. Of course this is going to be 1 plus H2 because that's the first performance. And we're simply going to drag this all the way down. And now we've done exactly what ChatGPT has said. Control Shift down arrow, click Insert, and you see this line, click Line, and there's a backtest right there. So it's pretty beautiful stuff as you can see. And I'm going to explain why we did this column thing first, okay? We had our strategy rules which we created. And we did this simply by reasoning in scatterplot. If this is this in the first 15 days, then in the last 5 days, we want to see this occur. So what do? We sell this, or we short it. Short and sell are hand in hand, buy and long are hand in hand. We short this, and what do? We buy this. Stocks and bonds is what these are supposed to stand for. We short this because we want it to come down here, and we buy this because we want it to come up here, because we want to sell high and buy low. And in the first 5 days of next month, because we expected this to happen, we buy this, and we sell this because we expect this to go down and this to go up. And then it can be applied the same way, vice versa. But the main thing for all of this is to first make sure if the relative performance is either positive or negative in the first 15 days. And that's what we're doing in this column. We're essentially saying in the first 15 days, is this positive? Is this a positive number or a negative number? If it's a negative number, okay, and then in this column, we're simply following the strategy rules, right? Times C2, right? Essentially what is happening is it's timesing to this E number to either long or short. If it's positive, it's longing. If it's negative, we're shorting. And this is going to be the this is going to be the last 5 days, and this is going to be the first 5 days. The trades that we're taking. So here, in the last 5 days, if we outperformed, what do we do here? We want to see if we underperform. We want to see if there's a negative correlation. And as you can see, there is. So what do we profit? We profit the spread. We profit this 0.43. So we can go ahead and put colors. Last 5 returns. First 5 returns. Cumulative returns. And this can be total returns. Or we can just call this return. The one to the right is going to be cumulative total returns. Essentially, this, based on this, that's why there's a minus E2 times, right? Because minus this, right, is going to do the opposite. Minus this is going to do the opposite. We want to see if there's an inverse correlation between these two. Because if there's an inverse correlation between these two, we profit. But on this one, we want to see if there's a positive correlation, so we don't do that negative E2 thing. So hopefully that made a bit of sense. Again, if you have any questions, simply come here and ask, can you explain these additional columns, why we are doing so? And essentially this does explain it, right? And it does it, but I tried explaining it as best as I could. We're essentially just following the strategy, and our strategy is simply based off the scatter plots which we made, which are these. And we've done it all within this video. And we've gotten this backtest. And as you can see, if we scroll down to the end, hold on, we see that we have gone from 1 to 33 which is a really significant. That's a times 33 return in 23 years. So in 23 years, we've went up 33x, which is really good compared to just buying and holding. And I have the buy and hold chart here. You can do this as well, but simply just get the S&P returns and simply ask ChatGPT to do it as well. Simply, you get the open and close for the same months. Simply use a monthly time frame instead of the daily. Get the data for that, and use the open and the close. Gather the returns and add them up. Get the cumulative returns, and you see this. Essentially, here's what I'll do. Hold on. Format. Trust workbook links. Let's go ahead and turn off this series real quick. No, we want to turn off the other series. Okay. So this is essentially how it is. This pink strategy is this backtest that we've just done, and this orange strategy is simply buying and holding the S&P 500. You can see how there's a big difference simply because of this simple strategy in which we're only trading S&P 500 and US 20-year Treasury bonds. We already get such a higher return. And you can calculate the Sharpe ratio. That's some higher level stuff. Essentially, you're calculating the standard deviation of these returns and comparing it to the overall return to see your risk adjusted return, which is Sharpe ratio. If you don't already know what the Sharpe ratio is, definitely recommend you guys to go ahead and search it up and learn about what the Sharpe ratio is. And again, using your favorite LLM, you can ask it to calculate the Sharpe ratio using these columns, and it will do exactly that. But essentially, we have this. So let's go back into our slideshow. And essentially, we have the same backtest type thing. That being said, we've shown that it makes profitable returns, but we want to attempt to smoothen these drawdowns as much as possible. And we want to see if there's any way that we can optimize. Why do we want to optimize? Well, we're trying to make this line right here as straight as possible. If it's very straight, if you apply leverage, it can go like that. If it's like this, with leverage, it can go like that. We essentially don't want these big drawdowns like here. We don't want it to drop significantly and then come back up. We want to have a smooth ride so that our compound interest can work very nicely, especially if you're allocating more and more capital to it. That's why a straight line is very, very nice. We want to smoothen things out as much as possible. The more smooth it is, the higher Sharpe. The more bumpy it is, the lower Sharpe. And that's a good explanation of the Sharpe as well. So essentially, we want to reduce this bump that we're seeing in the second half of the chart. Now, there's something called seasonality, and we want to see if there is any seasonality effects between stocks and bonds that could potentially negatively affect our returns, and see if there's a clear reason behind it. We can do this by plotting the returns by day for both. Essentially, there's something called seasonality, which are seasonal patterns in the returns of stocks and bonds. We want to see if there's anything relating to that affects our thing, right? Especially because we're using these first 15 days, last 5 days, next month. We want to see how the returns of SPY and TLT, we want to see how they do in each day of the month. What happens to SPY in the first half of the month? What happens to TLT in the first half of the month? Is it a smart idea to long TLT in the first half of the month if it's historically shown that it's negative in the first half of the month? We don't, right? So it may be a good idea to cross it off. But these are the things we're trying to identify, and we're trying to identify this through seasonality analysis. So here's the bar chart, and I'll go through this with you guys as well. Essentially, we have the chart here, but this is honestly going to be quite confusing to explain within this video. I could explain to you guys exactly how to do it, but it would make much more sense if I simply showcased to you guys that ChatGPT will do this for you. So once again, ask ChatGPT. I hold on. Give ChatGPT this prompt. I have the daily returns for both SPY and TLT historically. Now I want to create a bar chart that showcases the average return by day of month. Separately for each of the assets. We want to see if there's something going on that we may be missing out on that could be affecting our performance. And simply after this, simply say, I have X, Y, Z as my Excel columns, and can you give me equations? Give me equations or Excel functions so that I can achieve this goal of doing blah blah blah. Getting the getting the average return by day of month bar chart showcasing the separate average returns separately for each of the assets. Essentially you can prompt ChatGPT to do that. Here's the spreadsheet, and this is how I did it, right? I essentially marked out the returns by the day of month from historically, from 2002, right? Because we want the data to line up, of course. From there all the way down to the present. And essentially, we had this. We had the returns for that day of month for both of these assets. You can get that with the open, high, low, close data once again. Just simply subtract the close. Simply subtract the open from the close. And you get all these numbers, right? And you can get that using Python as well. Just simply ask ChatGPT to do that within Python. Paste the code into here, ask it to export it into a CSV, and you can import it into Excel, and you can do something like this. The more detailed your prompts are, the more information you give to the LLMs, the better responses it can give. So if you've been paying attention, just know that the most important things are how to play with ChatGPT, how to crunch the data, and how you can actually do everything that I'm doing with Excel. If you learn these skills and master them, you can go a long way. But essentially, you just average, you want to find the average. If EEE, if EE, if this is equal to J2, if this is equal to 1, what is it for SPY? So essentially, on the first, what is the average? This is essentially what it's asking. And it's essentially the same for all of this. And this is simply for TLT. So you can simply copy my functions, just adjust these columns here, and you can take advantage of that as well. But more importantly, it's important that you understand why I did this. We want to understand the relationship. So looking at this, with this given, and essentially I'm going to copy this and I'm going to put this into this book. Trust workbook links. What do we notice about this, right? And let's just go ahead and alright, let's just go ahead and go back here and simply do this, right? Let's insert cluster column. Let's do this. Is that, yeah, perfect. And then let's do this. Insert cluster column. The bottom is TLT, so let's just call this TLT. Hold on. TLT. And then this we'll go ahead and call it SPY. Hold on. SPY right there. Essentially, Are there any patterns that we notice in SPY? Any seasonality patterns? Does anything stand out to you? What do we notice? Well, there's a few things. The first thing is that in the entire stream, it's always positive. Almost, except for 3 days. It's basically SPY on average, it's going up most of the times. TLT, for TLT on the other hand, there's a very, very, very clear pattern. What do we see? We see that in the first 10 to 15 days, right? Or even in the first 5 days, we see that TLT is negative. We see this clear uptrend, right? We see that in the first half of the month, TLT is negative, and right at the end, it's positive. Now, this is a pattern that occurs. This is a very, very, very clear seasonality pattern. TLT is primarily down in the first half of the month, primarily positive for the second half of the month. And in our strategy, if that's the case, why the hell would we long TLT in the first half of the month? And why the hell would we short TLT in the last half of the month? It doesn't make sense, right, with these seasonality patterns that we just found. So, let's dive into a rabbit hole, right? And I'm pretty sure I included this. Right, we see this. We see this pattern that we've talked about. Well, it's a known fact through research that stocks, majority of the profits have been positive. And not just research papers, we've literally conducted that research ourselves. Primarily, most of it has been positive. That being said, we do see this pattern here that the 13th and 14th are almost always negative, and this 22. This 22 though seems to be a bit of an outlier simply because the 23rd is positive. But this does seem to have something, and we see that it's right before the rebalancing occurs, which the rebalancing occurs then. So here's a good exercise. Once I've concluded this video, and once you've created this strategy yourself, go ahead and take a look and see why this occurs. If you can find a solid reason, go ahead and change the trading rules to essentially short from the 10th, not from the 10th, from the 12th to the 15th. Short on the 13th and 14th for SPY. And think about why it happens. If you can find a clear reason, go ahead and do this. But from what I've searched, I couldn't really find a clear reason. That's why this is basically just noise. The main thing is that primarily most of it is positive. We see that start of the month bonds are down, end of the month bonds are up. Bonds, there's this mechanism called window dressing. In institutional manner, there are assets that look good and assets that look bad. Managers, right before their reporting period is done at the end of the month, not just rebalancing, but their reporting period as well, their holdings, what are they holding? Typically, they want a lot of the things that they're holding to look good for their investors. And that's why they buy bonds, because bonds are very, very, very safe. And their clients prefer safe things. If you want, you can dive into this window dressing phenomenon more. But it's essentially because managers want their portfolios to look good right at rebalancing, and because bonds look good, they buy it right at the end of the month. So now that we know this, we want to optimize our strategy. Literally, this is exactly what we've said. We only want to take our optimized trades. So we want to adjust our trading strategy and trading rules accordingly. If SPY is always up, why the hell would we short SPY at all? We don't want to short SPY. So that's what we're going to do. We're not going to short SPY. If TLT is always down in the first 5 days of the month, why would we long TLT in the first half of the month? That's why the first 5 days we don't long TLT. And in the end of the month, if TLT is always up, why would we short TLT? We don't short TLT. So essentially, we're removing this big bulk of our trades, and we're only taking these optimized trades. And essentially, I'm not going to go ahead and explain how you can conduct this optimization, simply because this video would be way too long if I did. Hold on. There we go. Wait. But essentially, everything will be linked in this Excel sheet, right? This is essentially what we're doing. We're removing this, right? And you can simply kind of do it within, right? Short SPY. You can go to our data where we're taking these trades, right? We're over here. What do we not want to do? We don't want to short SPY in the last 5 days. Okay. So, last 5 days, we don't want to short. When do we short? We short when it's positive, right? If it's a bullish, we short. We don't want to short. Essentially, we create a function that removes all the ones from this, right? And again, you can do this with the average if, or if this is that. You can ask ChatGPT, but essentially, you want to filter this column out. If there's a 1 here, simply delete it. And only use those returns. Furthermore, if SPY is negative, we don't want to short TLT. So, okay, sorry, I kind of explained this wrong, but this is the cumulative returns. Essentially, we want to deconstruct everything to an extent and simply do this, right? Use these as benchmarks, but since we're not doing anything here, we simply get the returns for TLT and we simply get the returns for SPY, both buying if these parameters occur, and add those two up, then do this as well in the last 5 days if this occurs. I hope that made a bit of sense. I know you guys can understand why we're doing what we're doing. It's more of the technical aspects that can get a bit confusing. I don't want to go too in depth into that technical aspect because this video would get really technical, really boring, because I'm literally deconstructing everything with you guys. We literally did the back test, the average returns, strategies, everything. We did the Python using ChatGPT for those beginners. We've done all of that. So essentially, you got to deconstruct and find these returns. You got to separate them, right? And you want to have the flag once again. It's positive or negative regime. Then only filter by those returns, and do the green things that we've marked here. If you can do that, and if you can do that within Excel, that's not only a good exercise for you guys to learn, but that will also create a very nice equity curve. And this equity curve not only outperforms our old equity curve, which is a pink one, it does it a lot smoother. And in fact, it does it with a lot higher Sharpe as well. Our old strategy had a Sharpe of around 1. This strategy has around 1.5. And a plus 0.5 increase in Sharpe is really significant. So it's very, very impressive. And if you compare it to the S&P 500, it's super duper impressive as well. Again, here's the back test as well. So now that we've tested the strategy and objectified the edge, we want to start putting real capital to it. We've done this with data. We've seen that it works. So we want to put our real money on it. We want to start making money with it. Now now we know how to trade objectively. We're not trading off of subjective, we're not trading subjectively. We know that this strategy works. So we want to allocate capital to it. But before you implement, you should test out of sample for additional robustness. Essentially, there's a few other things that you may want to do. Right now, this strategy could be able to be implemented in the real world, but typically you want to test out of sample. And what testing out of sample means is you want to just simply use different data sets that are not used in our data set, see if the back tests work out the same way, if the relationship is there as well. You can either use older data or lower data or simply small segments within our data as well. Definitely recommend you guys to research what out of sample and in sample means as well. But essentially, the next step is to use interactive brokers, their API, and use Python using Jupyter or whatever to essentially run the trades for you. I will not be telling you guys how to do this simply because that's a whole nother topic. My job isn't to tell you guys how to implement it. My job is simply to tell you guys how to create these strategies and how to trade objectively. So, I definitely recommend you guys to do your own research and learn how to use IKBR, interactive brokers, to run these strategies. And using ChatGPT, you can probably ask ChatGPT, can you give me the code in Python to input to interactive brokers API to trade using this strategy and simply line out the parameters of your strategy. You can simply submit a screenshot of this right here. And it can probably do it for you pretty well. Definitely want to check it a few times before you implement it, but it should do pretty well. As always with LLMs, you got to be careful. When testing using data, it's good because we're using Python to get the data so we can avoid hallucinations. But when using their code to trade, we want to be extra careful and double check the code to make sure no errors occur and everything is correct. So ask it for thorough explanations and much more. So we're almost at the end of this, but you want to understand what alpha decay is. Alpha decay is essentially when the edge loses its profitability. The returns start to plateau. This occurs because too many people have found this edge. Alpha decay is another topic that I definitely recommend you guys to go ahead and research more. But we want to monitor and see when alpha decay is occurring. Already within the tests that we have done, we've seen that a little bit of alpha decay has occurred. Why do I say this? Well, it's simply because our R squareds have decreased a little bit. This used to be a higher R squared. This used to be a higher R squared. This, I'm not sure if it was higher or lower, but these two were definitely a higher R squared. And now they're starting to reduce. And we don't necessarily want it to reduce. We want to maintain a high R squared. That's definitely a good test to find out and track alpha decay as well. Have and regularly run scatter plots. Potentially at the end of every month, simply add new data to your scatter plots and see how it's changing from time to time and monitor that. It shouldn't be too difficult. But with that being said, this is essentially what I said. If the strategy plateaus, it's a signal of decay. But if it plateaus during bad market conditions, this is one thing as well. It's likely a normal drawdown. You don't want to just find alpha decay using drawdowns and viewing drawdowns. You want to use these statistical tests and view if the relationship is actually decaying, not just the bad market conditions. And within bad market conditions, I typically would just let the strategy run until we get into good market conditions. And if it doesn't work well in good market conditions and the statistical tests are showing signs of decay, that's when I start to be worried of alpha decay and implement new strategies. But you can see this new data. If the R squared reduces and correlation flattens, maybe alpha decay is occurring. So this is basically it. But all that I've done in this video is showcase to you guys how to create a trading strategy objectively using data and historical and proper hypothetical thinking. We created this very nice framework that I definitely recommend you guys to refer back to whenever you create your strategies. We found strategies that not only make sense, but they make sense objectively. And we know that through a backtest, historical backtest, not just a few samples, we have 300 trades that we're taking almost. It's pretty objective that this strategy works. And we know that the strategy works as well because of our statistical tests that we've done. There's a clear visual identification that the edge is there. Everything is objective. Now imagine we're a retail trader and we're just figuring out of this because of something we've read on an article. But what if we do the complete opposite of what we're doing in our strategy? They would get completely wrecked, all because they've seen something on an article which they haven't verified and tested. Objective data, subjective data might work sometimes, but how will you test it? That's the main thing. You want to test everything out, and that's honestly one of the main things in trading. Hedge funds nowadays, majority of their strategies are quantitative, and they're quantitative for a reason. They have proof that it works. That's why I recommend you guys to somewhat take from these hedge funds and learn to trade objectively as well. With this framework, you can attempt to find almost any edge idea and test it objectively. So you don't have to make any more assumptions or guess once again. You can find your edge ideas in various places, but hopefully with what you've learned today, you can go ahead and start practicing and testing it out in the real world. So I'm really happy to have been I'm really happy to have been able to teach you guys this. If you have any questions, feel free to reach out to me, comment down below, or contact me in any means necessary. But this is essentially all I have here for today. Refer back to any part of the video, refer back to the slideshow, refer back to the master Excel document, and you can also refer back to my Python code and more. I will have that all linked in the description below and the Google Drive folder which I'm uploading. So I definitely recommend you guys to check that out. But with that being said, that's all I have here for today. And I might see you guys once again with these types of videos when I come to my final works for ISM. So with that being said, thank you so much, and I hope to see you guys and teach you guys more about this in depth, more with order flow, in more of an intraday perspective, very, very soon. So, thank you.